The West Asia war has likely come to an end, but the profits for some have not. 5 months after the US and Israel launched Operation Epic Fury against Iran, Wall Street and the defense sector is still cashing in. Under Trump 2.0, General Dynamics stocks has surged over 23%. L3 Harris is up 15%. Lockheed Martin has risen 13%. The new defense authorization bill now calls for $1.15 trillion in military spending, and that marks the first time defense spending bill has crossed the $1 trillion mark. Defense firms trade at 22 to 25 times forward earnings, a premium history rarely supports. The market isn't betting on peace, but it is betting on the backlog of military equipment depleted during the war. Overall, Wall Street benchmarks have been in lockstep with defense stocks. But step back and the broader economy tells you a very different story. The S&P 500 is up 9% this year, but core inflation sits at 2.9% and headline inflation at 4.2%, well above the Fed's 2% target. Both those inflation measures are climbing and not falling. The US Central Bank under new chair Kevin Warsh just held rates, but markets are now pricing a rate hike by the month of October, a sharp reversal from earlier bets on cuts. Unemployment has sat around 4% for nearly a year now. And the reason for the steady reading is because some Americans have stopped looking for a job entirely. And that's pointing to a soft landing and an economy decoupling from Main Street. The war itself hit global supply chains hard. The World Food Programme says food insecurity may have now touched of 363 million people worldwide, driven by the Strait of Hormuz disruption and an energy price shock. So who benefited? Well, defense contractors, certainly. Energy traders, likely. Ordinary Americans facing sticky prices and a Fed that's turned hawkish again, not so much. With midterms on 3rd of November, that gap between index charts and grocery bills may be Washington's next real battle.